If you ever manage to save up a serious pile of cash, you inevitably run into the classic financial crossroads. Do you buy real estate or do you invest in the stock market? Let's look at Ethan and Lucas. They're both 28 years old, and after years of living below their means, they've each managed to save exactly $50,000. Ethan decides to put his entire 50 grand to work as a 20% down payment. He buys a $250,000 rental home right in the middle of a quiet suburban neighborhood. Right out of the gate, his numbers look fantastic. He finds a tenant almost immediately, and after paying his mortgage, Ethan clears roughly $470 in positive cash flow every single month. Lucas takes a completely different route. He puts his $50,000 into a total stock market index fund, a single asset that buys him tiny pieces of thousands of companies, sets up an automatic monthly transfer of $200, and then just closes the app on his phone. On day one, their psychological experiences couldn't be further apart. Ethan owns a physical house. He has a tangible asset he can actually touch. Lucas's wealth feels entirely invisible. It exists as nothing more than a few pixels on his screen. To their peers, Ethan looks like a highly successful investor making bold moves. Lucas just looks like he's sitting around doing absolutely nothing. But we have to look past that surface-level illusion. Does collecting a physical rent check actually make real estate the superior way to build wealth? Or is there a massive mathematical blind spot we're failing to measure? Fast forward to year 3. This chart breaks down Ethan's initial returns. You can see his gross rental income bar on the left, his smaller mortgage payment bar next to it, and a very healthy green profit margin between them. On paper, he has generated nearly $17,000 in positive cash flow. But that profit margin doesn't stay green for long. Notice how these new expenses systematically slice away his cash flow. Property taxes, insurance premiums, routine maintenance, and the inevitable vacant months between tenants quietly drain his on-paper profit down to almost zero. And none of that accounts for the cost of his time. Ethan manages the property himself, which means he's fielding late-night phone calls about broken water heaters and spending his weekends meeting with contractors. Meanwhile, Lucas hasn't answered a single phone call or fixed a single leaky pipe. Thanks to his passive initial investment and those steady $200 monthly inputs, his portfolio has quietly grown to $76,000. At this stage, it looks like Lucas is winning effortlessly, but Ethan holds a hidden structural advantage that changes the math entirely: leverage. Leverage allows you to control a massive asset with a fraction of the cash. Ethan controls a $250,000 property that goes up in value as the housing market rises, but he only had to risk $50,000 of his own money to get it. Yes, those hidden operational costs absolutely bleed his monthly cash flow dry. But in the background, leverage allows Ethan to build tens of thousands of dollars in pure equity as his tenants pay down the debt, a powerful advantage that index funds simply cannot replicate. Let's jump ahead to year 10. This is the exact moment Lucas's strategy enters an entirely new phase. This graph tracks Lucas's overall wealth. Notice how the total balance curves sharply upward here. His market returns are now generating more annual growth purely on their own than the actual $200 he contributes each month. That is the sheer mechanical force of compound interest. Ethan is also sitting on impressive gains. He has built roughly $180,000 in equity. But getting there required replacing a roof and handling plumbing emergencies, draining $30,000 directly from his pocket over the decade. When you pull back and look at their total net worth after 10 full years, something surprising emerges. Mathematically, they are almost perfectly tied, yet the risks they carry are worlds apart. Ethan's wealth is highly concentrated. It relies entirely on a single physical structure, located in a single neighborhood, while carrying hundreds of thousands of dollars in debt. Lucas carries zero debt. His wealth is spread across the entire economy, holding liquid fractions of thousands of different companies that he can sell instantly. By year 10, neither investor has definitively won. They are simply operating two entirely different mechanical engines, one fueled by active management and debt, the other driven by passive patience, and somehow they have arrived at the exact same destination. Let's run the clock to the final 20-year mark. After 2 decades of ownership, Ethan has built $385,000 in home equity and managed to squeeze out about $120,000 in lifetime net cash flow. Ethan's equity and cash flow total $505,000. Beside it, Lucas's index fund rises past him to $518,000. Over $420,000 of that is pure compound growth, untouched by debt. Over 20 years, they utilized completely contrasting financial strategies and lived vastly different lifestyles, only to end up with nearly identical wealth. But the final numbers don't show what it actually took to get there. Lucas had to pay a steep psychological toll, watching years of savings evaporate during devastating overnight market crashes and finding the iron discipline not to panic and sell. Ethan paid a physical toll. He spent 20 years contributing active sweat equity, sacrificing his weekends for repairs, managing tenant disputes, and constantly carrying the massive concentration risk of a single property. The endless tribal debate between stocks and real estate entirely misses the point. There is no universally perfect asset. There is only the investment that aligns with your personal temperament and the specific life you actually want to build. So when you evaluate any strategy for building wealth, you cannot just look at the final dollar amount. You have to ask yourself, did you include the hidden costs of your time, your stress, and your risk?